So today I wanted to talk a little bit more about the theft loss approach and what that entails and really what position you are taking on this. So obviously I have put out a guide on how to take this as a capital loss, viewing the distributions as forced liquidations of your old assets in exchange for the new assets. Now this theft loss approach is a different approach, and essentially what we're using here is the idea that under IRC 165C2, any transaction entered into for profit is actually, and then there's a loss resulted from that, is actually a deductible loss. So ever since the 2017 Tax Cut and Jobs Act, personal casualty and theft losses have been disallowed. However, as we know, under IRC 165C2, there's an exception for transactions that are entered into for profit or for the assumption of profit. So that is what Celsius falls into. We know it was a fraud. Mashinsky pled guilty to 2 counts of fraud in 2023 or maybe 2024. And then, so we know this is a theft loss. And then B, we know that every person that got involved with Celsius was doing so under the assumption of profit, looking to take advantage of the various different earn programs they had and different opportunities on the platform to profit. So because of those two facts, we know that this was a profit-driven loss. There's assumption of profit, and the loss is a theft loss because Mashinsky pled guilty to 2 counts of fraud, so it's a theft loss by means of fraud. Now, what we now have to distinguish and kind of break down is why 2024 is the year to claim the loss. So essentially, the bankruptcy loss rules distinguish that a loss can only be claimed once the loss is sustained, which, not to get too technical here, but a loss is sustained in the year the theft occurs. However, if there's a reasonable prospect of recovery, then it's not deemed to be sustained until there is no longer reasonable prospect of recovery. So what that means is even though the loss happened in 2022, there was reasonable prospect of recovery. And so because of that, the loss was not deemed to be sustained until that reasonable prospect of recovery is eliminated. So I have an Excel sheet here that breaks down essentially what's happening. And this is for class 5 creditors, and I know some of these numbers are potentially a little bit different depending on your specific situation, but this is just a high level overview of the loss, and I just want to talk through it and essentially explain the position that's being taken. So on July 13th, 2022 at 8:10 p.m. Eastern, there was a snapshot taken of all the different types of assets that could have been held on Celsius and their fair values. So at that time, the fair value, the snapshot was taken. Your assets that were held on the platform were, analyzed against that snapshot to determine the fair value. And then, unless you specifically opted out of the class settlement claim, you were given a 5% markup. So your claim is essentially the fair value of those assets held at that time with a 5% markup. So basically it was like, all right, what happened? We went bankrupt. We're pausing. We're taking a snapshot at this time. And now we're going to give a 5% markup. This is your claim, okay? This is simply just a representation of what you lost. Now, fast forward to January 29th, I believe, 2024. The final bankruptcy plan was approved and completed and confirmed. So at that time, it was determined that 79.2% of your claim was going to be recoverable, okay? Leaving the remaining 20.8% as unrecoverable. This is essentially the fixed point and the event that we are pointing to substantiate the idea that this loss can be taken in 2024. So essentially what's happening here is we determined a splitting moment, the plan being approved, where the 79.2% portion was confirmed this will be recoverable. The remaining portion is not going to be recoverable. So essentially and effectively removing reasonable prospect of recovery for this portion of your claim. So just going down into the details of the recoverable portion of your claim, 28.95% was paid out in Bitcoin, about 28.95% was paid out in ETH, about there might be some give and take between these two. 14.9% was paid out in stock, and then there's a 6.4% miscellaneous it's going to be paid out in miscellaneous assets. The first portion was actually paid out in Bitcoin, so we can see here 2.53 was paid in Bitcoin, but this is from the sale of illiquid assets. So as we can see in 2024, these large portions, and in some of this was, substantially paid out. So this approach is not taking a loss for this unpaid amount because there is reasonable prospect of recovery. This approach, your position that you would be taking if you were to take this approach, is that we are taking a loss because there is no reasonable prospect of recovery. Recovery doesn't have to be impossible, and you don't need to be an incorrigible optimist. Basically what that means is it doesn't have to be impossible to recover from this amount. It just has to be reasonably unlikely, right? There's no reasonable prospect of recovery for this portion, so we are carving that out and realizing the loss for that. Again, this unpaid amount we are not realizing a loss for because there is reasonable prospect of recovery. So effectively what we're doing is we are drawing a line in the sand here. Okay, we are drawing a line. Looks like my Excel is freezing up here. We're drawing a line in the sand, and essentially we are going to carve this out of the rest of the claim. So what that means is, hey, this was our total claim. This was just a snapshot of the overall fair value of our assets held plus 5% markup. January 29th, 2024, the court, the plan is approved and confirmed. 79.2% is going to be recoverable. That's our recovery. 20.8% is unrecoverable. The loss is fixed. We can point to a court case where a bankruptcy plan confirmation has fixed a loss. So we know that now the loss is fixed. We know that this was a theft loss and that this loss was entered into with the assumption of profit. Because of those things, we are now taking the position that 2024, the theft loss was sustained, and therefore we are now claiming that loss. So we get a lot of questions about, okay, what if I only had stable coins? The calculation is pretty easy. If you only had stable coins, it's fairly simple. There are nuances with the returned Bitcoin and returned Ethereum kind of being carved out from this. But here's a quick little example if you only had stable coins. So let's say you lost 100,000 USDC. You had a cost basis on that USDC of $100,000, dollars, because it's one for one. In reality, your cost basis might be a little bit more. So if you had transaction fees to purchase the USDC, so maybe you purchased 100,000 USDC, but there's $2,000 in transaction fees. You might have a little bit extra of cost basis there, but let's just keep it simple. Let's just say it's one for one exactly. Your claim value is going to be 105,000 because of this 5% markup. Now, the recoverable portion of your claim, the recovery made in 2024, is 79.2%, so 83,000. So it's 79.2% of this value. And then the unrecoverable portion is this 21,000. Okay. Now, the way that the loss is calculated is I'll just click into the formulas here. It is the recoverable amount minus the cost basis. Okay, so the recovery minus the cost basis, and that is your claimable loss. It is not going to be this unrecoverable amount. That's not what you would use. What you would use instead is the recovery minus the cost basis, of the assets that were lost. Now, again, there are some complications that can arise because if you had Bitcoin and Ethereum and now you're being returned Bitcoin and Ethereum, we can treat that as a non-taxable event with the cost basis just being inherited. But again, the high level here, if you are going to be taking the theft loss position, it's important that you understand what position you are taking and why you are taking it. And essentially, again, this is a theft loss. Mashinsky pled guilty to fraud, so we know it's a theft loss. The loss was entered into with the assumption of profit. We were engaging in Celsius with the assumption of profit. And then why 2024 is when the year when the loss is sustained is because the bankruptcy plan confirmed that 79.2% is recoverable, 20.8% is unrecoverable, and therefore we know that the loss is fixed. Therefore, in 2024, that loss is sustained. So we can point to that. This remaining amount, so essentially the idea is that the recovery has been made, this amount is simply unpaid. So it's just like accounts payable, let's say, or accounts receivable. The recovery is there, we just have not yet been paid for this remaining amount, but we are going to. So that's why we are not claiming a loss for that. We're only claiming a loss for this portion. So hopefully that clears things up. We are going to, if you are taking this position, I highly, highly, highly recommend that you attach a memo to your return explaining this. Anytime that the 4684 is submitted, there's usually more eyes on it than normal. So having a memo explaining, what this loss relates to, why it qualifies under IRC 165C2 and why it's a theft loss, and then how the loss is calculated will certainly help, hopefully explain away any confusion so that any audits can be avoided. In the event of an audit, it's important that you understand the position that you took and why you took it and why you're comfortable with it. So it's very, very important that you are aware of all of this. And then, like I said, if you're going to be submitting this, definitely attach a memo to your return. In our course, I'm providing a template that can be used as an example, to fill out and file with your return. So if you want access to that template, you can join our course where I show you how to do all of this, with ease, and then fill out that 4684 on your own. All right. Well, thank you so much, and I will see you next time.